I think paper gold is no different than dollars, ultimately. And I think paper Bitcoin is no different than dollars. Foreigners could have taken every dollar of debt that they held, showed up, gotten U.S. gold theoretically at market, swapped it for U.S. gold, and the U.S. still would have had 35% of their gold left over. So our foreign debt was 135% gold backed at market prices. Today, that number's 8%. They've done galactically stupid things fiscally with borrowed money for 25 years. And you don't get, even America doesn't get to do galactically stupid stuff with borrowed money forever. You have to pay the piper. How do you pay the piper? You screw the real value of your bonds.
This podcast is entertainment, not financial, tax, or legal advice. Views expressed represent statements of the speaker in their individual capacity, do not represent the views of Unchained, and should not be considered investment advice. Speakers often have personal, family, or business connections to Unchained, which may include direct financial benefits. Please see our disclosure at unchained.com/podcast.
Hey, everybody. Welcome back to the Bitcoin Frontier podcast. This week, I have on Luke Gromen. Luke, welcome.
Thanks, Joe. It's great to be here. Thanks for having me on.
Absolutely. Thanks for taking the time to do this. Luke, you've been thinking about markets for years. What's like one under the radar trend that you think investors or the market is not paying attention to right now that maybe they should be paying attention to?
I think the thing they should be paying attention to now is the U.S. fiscal situation as it relates to what we've termed the U.S.'s true interest expense, which is the gross interest on its on-balance sheet debt, which is just interest expense. And then the interest on its off-balance sheet, which is just the current portion, the pay-as-you-go portion of the 100 to 150 trillion in off-balance sheet liabilities or debt entitlements. And when you add those two things together and compare them to federal tax receipts, it's been a very good indicator. Anytime those things get over 90% and start moving towards 100% of receipts, the Fed and or Treasury start loosening dollar liquidity, either by cutting rates or running down TGA or however they need to do it, they get the dollar down. And that is important because on a fiscal year-to-date basis, we are basically right at 100% of receipts, true interest expense as a percent of receipts for the first time since we were coming out of the COVID crisis. And it's gotten pretty extreme in recent months. In the most recent data in August, true interest expense was about 150% of receipts. And in July, it was about 120% of receipts. So they need to cut rates. They need to loosen dollar liquidity. And it's not because the economy needs it. The economy's slower, but it doesn't really need the degree to which they are injecting liquidity. It's the U.S. government for whom fiscal conditions, borrowing conditions, financial conditions are tight.
Why do you think more people, like maybe more like traditional Wall Street type people, aren't thinking about this as well? Or would you say they are thinking about this?
I think they're increasingly thinking about it. I think there's of those that aren't thinking about it or are dismissing it, I think they fall generally into one of two camps. The first is they stick their heads in the sand. It's basically hashtag America, right? Like, put up an eagle and put up a picture of an aircraft carrier and this will never happen to us. Okay, great. For the other portion, there is, I think, a more nuanced argument that does have some validity, which is they point out that though that's not debt, that's collateral. So, and at the short end, in particular, that's absolutely true. The U.S. government, that's not government debt, that is collateral for borrowing. Okay, fair. Then the follow-on second and third derivative of that is the U.S. government is emitting collateral. So explain to me why we think inflation is going to ever go back to where it was, and explain to me why I want to hold as my wealth asset collateral that the government is emitting 8% more every year for the last 17 years, CAGR. I don't. I want to own gold Bitcoin. So I think that's, the lack of that second derivative argument is sort of why that second group kind of poo-poos that. And that's fine. We can see it happening in the charts in terms of the impact of, gold outperforming treasuries, Bitcoin outperforming treasuries, stocks outperforming treasuries, sort of everything, and as long as you sort of wave your hands and say it's not inflation, you can sort of keep it all going until you start to have political instability in the United States, which is just about 8 years ago.
I don't know if I've ever heard you answer this question in particular, but I'm kind of curious to hear how you think about it very broadly. What is money to you?
Money to me, I think is I think is I would define it as is classically defined. It's something that fills three components, right? It's a medium of exchange, it is a store of value, and it is a unit of account. And the challenge is that you can only use debt-based money to fulfill the three of those for brief moments in history. That's essentially what Triffin's dilemma says. And we're past that moment in time where it makes any sense to use a debt-based money, as ours is, to satisfy all three of those. And so as the debt-based money breaks down, that system breaks down, I'm still gonna use dollars as a unit of account and as a medium of exchange, but only a fool would use it as a store of value as that system breaks down, as the amount of piles up. And that's basically what Triffin's dilemma says 50 years ago. Like, it's been the most predictable thing on the planet because it's just math, compounding interest. But that's, for me, as a result, what is money? Money's two things. I have my my unit of account and my medium of exchange money, and I have my store of value money. And those are two different monies. And they will continue to be two different monies for me, unless a set of conditions are met by policymakers.
Yeah, I like that. When I interviewed Senator Cynthia Lummis, she said the dollar is short money and Bitcoin and gold are long money. And I think that's a great way to put it, like you just said. What would you say is the most crowded trade today? And what would you also say is the most least crowded trade today?
I think the two most crowded trades today, I think, are short China and long U.S. Treasury, long-term U.S. Treasuries. I think those are the two most crowded trades. I'm sorry, would you? Sorry, what's that?
And then the least crowded trade as well.
The least crowded trade.
That may be a good trade still.
I think it's still gold. Nobody likes gold. Nobody owns gold. People say, oh, I like gold. It's, what do you own? Oh, I've got call options. Oh, I own the miners. Do you own any physical bullion? No. Nobody owns physical bullion yet. They will.
Interesting. You recently published something talking about gold. I think the title was Gold Miners Are the New Commodity Stocks, and Commodity Stocks Are the New Bonds. Can you kind of elaborate on what you wrote there?
Yeah. So the gist of it is that the U.S. fiscal situation, as we highlighted earlier, needs negative real interest rates to basically just be sustained. So you got to have inflation. You have to have nominal GDP above rates, or else you go into a debt spiral in relatively short order. The problem, and historically, when you need to reflate your system in such a manner, post 71, after we went off the gold standard, we were basically on an oil standard. So basically, oil was made big enough to back the dollar in this, to recycle dollar outflows, dollar deficits into global oil market. The problem, and throughout my career, I've been doing this 30 years now. Obviously I read about it in the books. In the 70s, you needed to reflate. They reflated oil. You need, and gold went too, but the gold to oil ratio was stable through the 70s. The amount of oil that gold bought you was relatively stable. Moment in the late 80s, we had oil surge. Not really. Then when we needed reflation. So back in 2003, we were coming out of sort of this slow period, this deflation, a recession. Sort of the talk of Wall Street across late 02 into early 03 was reflation. They were going to reflate. They're going to reflate. And they did. And oil went from, call it 12 to 150 over the next 5 years, trough to peak. And gold went from 300 to 2,000, trough to peak. Again, the gold to oil ratio didn't really move a lot during that period of time. The problem we have now is that the sovereign debt, not private debt, sovereign debt, particularly in the West, is so high that if we use oil in particular and commodities more broadly to reflate, you're going to send commodity oil prices to levels that are guaranteed to trigger stagflation. So historically, anytime the United States spends more than 3% of GDP on oil, and that's just price per barrel times barrel consumption per year divided by nominal GDP, anytime it gets much over oil consumption gets much over 3% of GDP in the United States, the U.S. has best case stagflation, worst case a bad recession. You can't have stagflation or a bad recession when sovereign debt to GDP is 120 or 25%, because you're going to quickly get into having to either inflate the debt, default on the debt, restructure the debt. Those are your three options. And obviously the only choice is inflate. So that means the rules have changed and most of the street hasn't even realized it. Now you need to inflate something that isn't used for anything, right? And so the biggest ding on gold amongst most Western investors is gold isn't used for anything. Oil is. I want to own oil. Gold isn't used for anything. Copper is. I want to use copper. But the problem is that global central banks and Western central banks in particular massively need to reflate, massively need to recapitalize their balance sheets. They need to keep real rates negative. But if you use oil to do it, you're going to crash the economy, not stimulate it. You're going to stagflate the economy. You're going to break the global sovereign debt markets, and you're going to probably starve tens, if not hundreds of millions of people, right? I mean, we all saw what happened when oil got too expensive in the Arab Spring. And so imagine trying to reflate 35 trillion, reflate out of 35 trillion of debt using oil. You're going to need oil at $500, $1,000 a barrel, and the entire real economy shuts down. So now the debt has gotten so high, you need to reflate something that isn't used for anything. If gold goes to 5,000 instead of oil going to 200, who cares? A bunch of Indian housewives are a lot richer. A bunch of Chinese consumers are a lot richer. Oh, by the way, these are things that global and U.S. policymakers are trying to incent anyway, so they consume more of their own production. And so once you come to that conclusion, you realize gold has to be the release valve. They have to inflate something that isn't used for anything. And so now you're seeing the gold to oil ratio blowing out. Whereas prior reflations, it's been a steady ratio, gold and oil are higher. Now we're seeing gold much higher and oil's $70 to $90. And in that world, gold is the release valve. Gold miners are the new commodity stocks, as most Western investors have played them over the last 40, 50 years. And commodity stocks, in particular oil stocks, are the new bond, because you're going to, I think oil's been $70 to $90 range for the last 2 to 2.5 years, managed by the U.S. government, by the way. SPR releases, SPR refills, et cetera, et cetera. I think it's going to continue. I think oil is going to continue to trade 70 to 90. It needs to be below 90 because above 90, it starts impacting the treasury market. And below 70, U.S. shale start. And that doesn't help either. So for the foreseeable future, I think we're going to see, I think we're going to see oil 70 to 90. And that means commodity stocks aren't necessarily huge upside like they have been in prior reflations or negative real rate environments, but they're really good bonds because they're just going to, I think you're going to see them clipping coupons. And I think you'll see PE multiples in oil stocks and in commodity stocks more broadly expand as sort of the volatility of commodity prices is not what it was under the petrodollar system. The volatility of prices is going to be in gold.
Secure your retirement with a Bitcoin IRA from Unchained. Right now, get started with no setup fees and enjoy your first year free. You can open a Roth and traditional Bitcoin IRA and even upgrade old forgotten 401ks and IRAs into tax-advantaged Bitcoin where you control the keys. Get started today at unchained.com/frontier. There's no better way to hold tax-advantaged Bitcoin for decades. That's unchained.com/frontier. And now back to the show.
Mostly with upside volatility for the foreseeable future and eventually maybe more overall volatility once gold gets much higher levels than it is today.
Yeah, it's very interesting. So if gold miners are effectively the new commodity stocks, are bonds basically just complete garbage, like actual bonds?
I think it depends on the bond. I think Western sovereign bonds, mid to long duration. Look, there are people out there who have to hold them for regulatory purposes, for duration matching. I get it. The fact that the government is regulating you into buying their paper should tell you what the odds of that, what the odds of that providing you with positive real returns is. That's neither here nor there. So, but beyond those, unless you have to own long-term Western sovereign bonds for regulatory purposes, yeah, I think they're trash on a real basis. I mean, you're getting paid every dime you're owed. You might even make a little money on a trade, but even if you make a little money on a trade in these bonds, gold's going to outperform. Stocks are going to outperform because of the drivers that you need to make you some money on a trade for those long-term bonds. So, like best case, they're a suboptimal expression of a trade, and worst case, you're going to lose a lot of money on a real basis, even as you get paid every dime you owed. So, yeah, I think Wall Street doesn't realize this sort of the 40-year 60-40 model is dead. It's now 60% stocks, 35% commodities, gold, and I think there's always interesting individual bonds, assets, etc. So I would never say like all of them can be thrown in the trash, but the sovereign government side, like they're just, I don't know, it's just like blood sport. You trade them if you want, but like I'd rather live my life.
Do you think we would ever go back to a period where we actually do use the traditional 60-40 portfolio where like 40% are actually back in bonds, or like that is actually a quote unquote like good long-term trade, or is that done for forever?
You never say forever or never in this business, right? Look, it's a function of sovereign balance sheets. I own gold, I own Bitcoin, and if we have a period of 5 or 6 years of negative 10 to 15% real rates, and at the end of that 5-year period, U.S. debt to GDP, for example, is no longer 125, but it's 30%. And gold is $12,000 or $15,000 an ounce, and Bitcoin is $300,000 or $400,000 or $500,000 a coin. And the U.S. government's offering me 4.5 on a 10-year. They can have my gold. They can have my Bitcoin. I'll put it all in 10-year treasuries. They've restructured. I'm happy. This isn't some jihad against U.S. government debt or whatever. I'm just trying to act in the best interest of my clients and my own money on a real basis. And if they, and by the way, this is exactly what happened in the last cycle. 1945 U.S. debt to GDP's 110%, and in 5 or 6 years they work it down to 55% of GDP, and then they pull off the yield curve control. They do that massively negative real interest. And then we do guns and butter, Vietnam, go off the gold standard, blah, blah, blah. By 1979, 1980, 1981, debt to GDP was down to 25, 30%. And gold as a percent, the market value of U.S. official gold in 1980 relative to the foreign held portion of U.S. treasuries was 135%. In other words, foreigners could have taken every dollar of debt that they held, showed up, gotten U.S. gold theoretically at market, swapped it for U.S. gold, and the U.S. still would have had 35% of their gold left over. So our foreign debt was 135% gold backed at market prices. Today, that number is 8%. The long-term average is 20%. Or excuse me, it was 20% when the Berlin Wall came down in 89. The long-term average is 40%. So like and ironically, nobody wanted to own long-term treasuries in 1980. They all wanted to own gold. That's a gold bubble. So for me, it's really about what are the market conditions. Debt to GDP, 25, 30%. The real value of treasuries has already been killed relative to gold, relative to Bitcoin, relative to stocks. I love America. I think it's a great place. I think it's the best country in the world. And they've done galactically stupid things fiscally with borrowed money for 25 years. And even America doesn't get to do galactically stupid stuff with borrowed money forever. You have to pay the piper. How do you pay the piper? You screw the real value of your bonds for a long enough period of time, reset the system, and then you move on. And it's happened over and over and over in every country of the world. And most American investors, you say this to them, and they're like, oh, but where do the zombies come in? There's going to be a zombie apocalypse. And if bondholders, it happened from 46 to 51, no zombies. It happened from 65 to 80, no zombies. Like, bondholders lose. Thank you for a donation. Have a good day. So I would reinvest capital gains in assets that have inflated relative to treasuries at the right price. Everything's a function of price and situation. I've got, a government that is highly indebted, doesn't have enough money for transformers for North Carolina, but is shipping $8 billion to Ukraine the week before. Those are not serious people. I don't lend money to people like that, not for a long term. I'll give them money 5% short term in T-bill markets. Sure. I'll give them payday loans, but those are not fundamentally serious people about the fiscal situation.
Yeah, so this like repricing event where hard assets increase a lot relative to, I guess, long duration bonds. How long do you expect this period to start or to last? And like, has it already started? When did it start? And when do you think it might end?
I think it started in 2014 when global central banks stopped growing their holdings of treasuries. So global central banks have not lent the United States an additional dime in 10 years. So we're already 10 years into this. And that is at a very predictable set of responses. Paradoxically, it sent the dollar up. It forced U.S. banks, money market funds, pensions to be regulated or enticed into buying more treasuries, U.S. banks. It forced the Fed to start regrowing their balance sheet. So we're already into it, and we can see, starting in 2014, gold has outperformed long-term treasuries by 7% per year, CAGR. S&P has outperformed by, I think, 12 or 14%. NASDAQ's outperformed by 19% CAGR, and Bitcoin on face-peeling volatility since 2014 has outperformed long-term treasury bonds futures by 74% per year CAGR. So we're already a decade into this, and the crazy part is that we haven't even really we've only just started the hockey stick part of this movie in the last 2 years, I would say, after we sanctioned Russian FX reserves and after we started weakening the dollar in 3Q22 after our strong dollar rate hike, dollar wrecking ball shot off our own arm. And Yellen had to start running down the TGA to weaken the dollar. So, 2 years ago, the dollar DXY was 114. We're at 100 today, 2 years later. So I think this repricing event is now into the acceleration phase. And again, Treasury bonds are get paid every dollar they're owed. In this time, 10 years gone from whatever, 2 to 5 to 3.75 to 3.8. Probably will trade 3.8 to 4.5 to 3.8 to 4.5. And in the meantime, the S&P will double and gold triple or quadruple, and Bitcoin will go up 5 or 7x, something like that. And great. And if that's enough to get the GDP down to 100, from 125% to 25, 30, 40%, and I would probably start to let some go and shift back into bonds, long-term bonds, at 70%. At least that's manageable, from which the Fed can not be in fiscal dominance, not have to do whatever Treasury tells them. But until we're at that point, this is going to continue and accelerate. And the crazy thing is debt to GDP is actually reaccelerating on the upside. It's not even falling. It fell for a little bit, but now it's reaccelerating on the upside. So it's still we're in the early phase of the acceleration phase of this movie, which is if you own gold and Bitcoin and stocks, relative to bonds in particular, long-term bonds, the most exciting part of the movie, the most fun part of the movie.
Fair. Back to the idea of gold miners are the new commodity stocks. What are the new gold miners then? Is that Bitcoin?
Maybe. Maybe. I mean, I hadn't thought of it like that, but I've said multiple times that I think part of the reason gold miners have not responded to the price of gold the way one would have thought ahead of time, at least not yet, has been that historically gold miners, particularly for generalists, has been, okay, I think gold is going to go up. I want something that is levered gold. I buy gold miners. And this cycle in particular, particularly with the launch of ETFs with Bitcoin, I think there has been an element where generalists say, okay, I think gold is going up. I want levered gold. I buy Bitcoin. So it would follow that is on some level the case, at least at this point in the cycle.
Fair. You mentioned earlier about a lack of people currently owning physical gold. How do you think about that entire concept of physical gold, physical Bitcoin, and paper gold and paper Bitcoin? What are your thoughts around those general ideas?
I think if you don't hold it, you don't own it. I think you have to understand your custodian to the extent you use one. I think you always want to be fully allocated in an Anglo-American jurisdiction, so at least you've got a shot of defending your claims in those cases. I think paper gold is no different than dollars, ultimately. And I think paper Bitcoin is no different than dollars, right? So let's talk through this logically.
In this frontier moment, Luke is talking about the concept of paper gold and paper Bitcoin. But what exactly is paper gold and paper Bitcoin? Or maybe more importantly, how can you be sure you're holding real Bitcoin? Paper Bitcoin could be Bitcoin held on exchanges or held by trusted custodians. You don't actually possess the Bitcoin until you hold the private keys yourself. And just like weighing and testing physical gold, running a Bitcoin full node is your way to verify that the Bitcoin you hold is real, unspent, and valid according to the Bitcoin protocol. So at the end of the day, not your keys, not your coins. And now back to Luke.
In the great financial crisis, the bullion or the big banks, the bullion banks, too big to fail banks, had problems. They were backstopped by the federal government with printed dollars. Paper gold, paper Bitcoin, to a lesser extent paper Bitcoin, but certainly paper gold, is ultimately an obligation of a bullion bank, of a too big to fail bank. And we know for a fact, from empirically, that a bullion bank, a too big to fail bank, is merely a contingent obligation of the United States government, which is ultimately dollars. So paper gold, by transitive property, is just dollars. It's a dollar proxy. It's not gold. And that doesn't matter until it really matters. And when that matters is, hey, gold just got repriced on Sunday night from 2,000 to 7,000. Awesome. I own paper gold and I'm going to be up tomorrow. And on Sunday night, you get a notification from your bank saying, hey, pursuant to agreement, blah, 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 what you signed when you open the account, you're cash settling your paper gold at Friday's close. Thank you for your business. And the gold that is on the bank's balance sheet, the upside accrues to the bank. They get to recapitalize their books. I'm not saying it would happen that way. It might not happen that way. But we know, again, empirically, in 2008, when faced with abiding contract law or preventing the banks from going under and printing the money and bailing out AIG at par, the government bailed out AIG at par to keep the banks from failing. And so I think it was a very important, case for anyone who owns something like gold or Bitcoin in terms of, okay, they warned you. You know what? I'm a big believer. My father-in-law always said, when people show you who they are, believe them. They showed us who they are. You know, as Dennis Green said more recently for the cultural meme, right? They are who we thought they were. They are who we thought they were. And look, you need to understand, you need to be self-custodied in your Bitcoin. It's easy to do. You need to be allocated in an Anglo-American jurisdiction in America at the absolute worst case. Best case, you want to own, not necessarily in America, but in an Anglo-American legal jurisdiction, with a tradition of Anglo-American legal. That's like the absolute minimum if you own gold. If you don't, maybe you own it, maybe. And you're not going to find out till you need to find out. And then you're going to be sort of sitting there crossing your fingers, hoping the answer is like, oh, good, I do own it. And the answer to do I own it or not in that case will probably be, are the big banks long or are they short? Because if they're long alongside you, then you do. And if they're short to you, as Michael Burry highlighted in the movie and in the book, they're going to cash out of you in all likelihood, in my opinion.
Yeah, it's quite fascinating. So I guess, would you say like GLD, like the gold ETF, that is like basically paper gold to some extent?
No,
Okay.
I can't really comment on any specific ETFs. I think all of the gold they hold is absolutely 100% there. It is theirs. It is allocated, as it's been explained to me. I think GLD is more of a trading vehicle than a gold ownership vehicle. If you want to own gold, own gold. Don't own. The more people between you and your gold, the more risk there is if things get really weird. I think they have all of it there. I don't think GLD is a point of risk. The point of risk, I think, is London, and where historically a lot of the GLD gold was, and the people, the amount of unallocated claims sitting in London. If GLD says they own an allocated bar and someone in London has also promised it to the Saudis and to the Russians and to China, now you're into a custodian allocation contest of who owns that bar. And as an American retail investor, I don't like my chances against the Saudis or the Russians or the Chinese at a sovereign level. I just don't. So that's like, to me, I think the GLD's fine. I don't think that's not, I would call it is that paper gold, when I say paper gold, it is unallocated gold derivatives centered in London. That's what I mean by that.
When you think about Bitcoin and gold together, do you view them more as like complementary, or do you view them as competing to some extent? Like, how do you think about that? Or are they both still so small and they need to be repriced so much that in reality, they're just both going to explode together, most likely over the next, 5-10 years?
Yes. No, I think they are both neutral reserve assets. And on that front, they compete. I think the fact that central banks, bullion banks, too big to fail banks, gold, and not that much Bitcoin, if any, tells you they compete. There's an element of Bitcoin is the neutral reserve asset for the non-status quo system, whatever that is. And gold is the one for the status quo. So they do compete. At the same time, they also are on the same team from the standpoint of, yes, they compete with each other. And yes, gold is 14 or 16 or 18 trillion in market cap, if you will, and Bitcoin's 1.2 trillion. But they both are competing against the $130 trillion bond market and the 65 trillion or 80 trillion equity market and the 500 trillion in real estate market. And so maybe it's not 500 trillion, maybe it's 200 trillion real estate market. Anyway, you get the point. What's a few hundred trillion between friends at this point? So they're on the same team in that way. And I think they both stand to benefit from flows. And I think the price of those other assets, particularly bonds, I mean, I just highlighted that bonds have massively underperformed gold, Bitcoin over the last 10 years. Stocks have done pretty well, depending on the stocks and on the indices. But I think increasingly, stocks are going to underperform gold and Bitcoin. I know they've underperformed Bitcoin, but they've performed okay with gold. I think stocks are going to increasingly underperform gold in coming years. I think they will continue to underperform Bitcoin, again, with face peeling volatility. And real estate, has really underperformed gold and Bitcoin as well, particularly over the last 5 years, 10 years, 5 years. And yet if you talk to a lot of real estate people, they don't get gold. I don't want to own gold. Gold isn't used for anything. Bitcoin isn't used for anything. They don't see them as hard asset proxies that may sort of, take capital out of their hard asset because it's more portable, less risky, right? Real estate's risky now because things are changing. Look, if work from home is permanent to some level, we're overbuilt commercial real estate office space for like the next, I don't know, but it ain't like the next 2 years. It's 5 years, 10 years, 20 years. Those types of things. So there's big changes happening in the real estate world that I think point to, for the average person, like I'm not smart enough to know when work from home is ever going to stop and when Amazon's going to stop taking share from light retail around the country and the world. But I got to own a hard asset. What do I want to own? Do I want to take a chance on this strip mall or this REIT or this or that, or just buy gold, Bitcoin? To me, again, it's, as Lynn Alden says, I put it in the too hard category. Too hard. Let's buy gold, Bitcoin.
Do you think we'll ever see a situation where central banks or large central banks actually do start allocating some portion of their assets to Bitcoin in addition to just gold?
I think it's possible. I think they understand it, at least some of them. So I do think it's possible. But I think between here and there, there's fight them, and then if you can't beat them, join them. And I think we're in early days of, maybe not super early days, but we're still in the early innings of fight them before they get to realizing we can't beat them and then join them.
Do you have a perspective of what's going on in China right now? I saw their stock market effectively was one of the worst performing markets of this entire year. And then recently it's absolutely exploded. Can you kind of explain maybe what's been going on?
Yeah, they came out with 2 different aggressive pieces of stimulus, lowering lending rates and supporting real estate markets, et cetera. And everybody was short China. And what's crazy is this week's Golden Week. So they did that last week, and now they're on holiday all week. So, what happens if it comes out later this week, early next week, that Golden Week sales were pretty good and spending was good, travel was good. Like people are sort of stuck. And I think there's a broader lesson here. I hear so many times, Luke, yes, you're ultimately going to be right, but path matters. I want to be, I know you don't like long-term treasuries, but path matters. We're going to have a slowdown first. Rates are going to go down. And then I'm going to switch out of my long-term rates. And then I'm going to buy gold, Bitcoin, and stocks. And then what you're saying is going to happen. It's going to happen. Maybe. And what I like to do then is ask those people, okay, fair, totally agree. Tell me how you traded COVID. And they say, what do you mean? They say, okay, so COVID, crash, deflation, blah, blah, blah. Yes. I said, were you short? And some of them will say yes. Some of them will say no. Of the ones that say, yes, I was short, I will say, did you cover anywhere near the bottom? And were you able to capture the upside on the back end? And most of them say, yeah, kind of, maybe. Tell me your numbers for that year. And a lot of times you find out they'd just been better off holding through the whole thing. Like it was too hard. Warren Buffett came out and said the Fed acted too fast for me to deploy my cash to buy anything. So you got the ultimate insider, Warren Buffett, the guy who gets the phone call every time something bad has happened, going back to like Solomon Brothers in like 86 or whatever that was, 89. I don't remember the exact year. He gets the call. When something happens, hey, Warren, you're sitting there with a bunch of cash. You want to buy this. And yet Mr. Insider, who's holding record cash, that's always cited to me as, oh, he knows something, couldn't buy anything because the authorities acted so. And so now I take that situation and the same thing. The people said, no, I wasn't short. They actually a lot of times did better than the people that were short COVID because they never sold. They were like, oof, that sucks. And then had a great year because they acted so fast. And so when I have that experience and I layer that on to what we're seeing in China, everybody hated China. Everybody wrote it down. It was a great trade. And then you just gave it all away in 4 days. And this week, it's not even really open, the economy. Now what? And I think it's very instructive around this whole, I'm going to trade it. We are in the biggest and first and biggest bursting global sovereign debt bubble in 100 years. We are in a divorce between China and the U.S. economically on some level, which is the economic relationship that has defined the last 25, 30 years. We are in a re-accelerating Cold War. We are at closest to the biggest fat tail risk of World War in 40 plus years. We've got a changing currency system away from unilateral pricing of commodities into multi-currency pricing of commodities. We've got central banks not buying treasuries for the past 10 years for the first time in history. That had never happened in the 70 years prior. And you're going to trade it? You're really going to catch both sides of it? You think and the highest debt to GDP in 100 years, like I said, you really think policymakers aren't going to respond fast? Repo rates spiked to 10, 12%, 10%, in September 19. It took the Fed 48 hours to respond. And then stocks ripped. So like if you were right, great. But if you're running like a real size book, like look, if you're running, a couple $1 million, sure, you could do that. But if you're running real capital, you can't reposition portfolios that fast. It's impossible. And so that to me is the biggest lesson of what I'm watching with China right now. If I was running serious capital, I'd be like, this is a huge lesson reinforcing what I learned in 2020, which is you got to express like negative views via derivatives, not taking off core positions when you're talking strategic, your strategy, because it just moves too fast. Like it's the debt levels are so high, the policymakers have to respond basically instantly. And so if you're taking off and repositioning entire portfolios, just happens too fast. So that to me is the most interesting thing about all.
Yeah, it's a really good point. I never thought about it that way. It's like at this moment, Bitcoin and gold are the highest long-term risk-adjusted return. And like, yes, maybe you could make some money buying long duration bonds if the market collapsed in a very short period, but timing that is basically impossible. And it's like, you might as well just jump the gun and be on the gold and Bitcoin train.
Well, yeah. And it goes back to the point I made earlier. Like, look, August, true interest expense was 150% of receipts. July, 120% of receipts. And what I didn't say then is that the key marginal driver to receipts in the United States is the stock market. Full stop. So if the stock market collapses and stays down for more than like a couple of weeks, they're not going to be able to pay entitlements and interest without printing the money. And so now you go, are they going to print the money or are they not? Even the most avid, or rabid bond bull says, well, of course they're going to print the money. Like, okay, so you're telling me I need to own long-term bonds or reposition my whole portfolio for a 2 to 3 week period before they start printing the money if the stock market crashes? And that's usually where they sort of, block me or hang up on me or, ignore me. They just wave the hand, whatever, which is fine. Like, so it makes markets, but that's my view.
I guess that's why it somewhat makes sense to hold very short duration bonds, because maybe there is that quick drop that you can deploy capital in, but
100%.
Holding long duration bonds makes absolutely no sense because you'd have to deploy it so fast.
Especially when I'm getting paid 100 basis points more than the short-term pay.
Fascinating. We have the presidential election coming up in the United States. Do you have thoughts on that? Or is it kind of this is the train has no brakes, as Len Alden says, or how do you think about it?
You're going to get me in trouble. No, I think it's, I think Stan Druckenmiller said it best yesterday at the Grants conference reported, where he said fiscal largesse is coming either way. U.S. interest expense is above defense spending for the first time in at least 65 years in practically speaking U.S. history. Every other country that has happened to, going back hundreds of years, has ceased being hegemonic relatively. So to me, it's shuffling the deck chairs on the Titanic. And that's not to say America is sinking to the bottom of the ocean, but I think the real value of U.S. Treasury bonds is sinking a lot lower. And so they, again, have the United States policymakers of both parties have made galactically stupid foreign, economic, trade, and domestic policy decisions for 40 years, mostly using borrowed money. And the problem is people say, well, it doesn't matter in the long term. Well, true, but the long term's here. The 40 years is the long term. 30 years is the long term. 20 years is the long term. The devil's here. You made a deal with the devil. He's here. He wants his due. And most Americans are still in denial about what that entails. But that's, again, to me, that's still the opportunity. That's why I say I think gold is still wildly underowned. If people really understood the math, everyone would own gold, Bitcoin in a lot greater quantities than, even some of the bulls of gold, Bitcoin.
If we do actually end up having this repricing event where gold and Bitcoin go, absolutely ballistic and people sell out of long duration bonds, does that change dynamics with governments and in general? Do governments have less power and less ability to borrow money and therefore they must shrink or no?
If we have the repricing event, and so gold and Bitcoin, it's a wave. Right now, our debt to GDP is where it is, and our deficit to GDP is where it is, and our true interest expense as a percent of receipts are where they are because the dollar is too strong. You get the dollar down, you get inflation up, you get real rates down, you're going to drive stocks up, nominal GDP up, growth up, inflation up, and you're going to get receipts up, and you're going to get debt to GDP down. And they have done that. We've already seen one iteration of that move, at least. I think we're going to see another iteration of that move, and that's going to lead to another repricing. And then they're going to think, not they're going to think. What's going to happen is inflation is going to be 10, 12%, and it's going to become a political issue again, like it was in 2022, and they're going to tighten prematurely. And then we're going to kind of go through this whole cycle again. And another couple times, eventually, then yes, the market just, after getting Lucy with the football enough times, or Charlie Brown with the football enough times with Lucy, they just demand gold and they don't sell. And then you get the repricing. It's probably another iteration or two out from here, but ultimately, then the market says enough. But I don't think we're there yet. Is the government going to shrink itself voluntarily? I doubt it. It's been the very rare government to do it. The one thing I will say is that the one government in the last 100 years in the West that I'm aware of doing it, let me take a step back. There's two ways to do it, to get rid of your debt. After World War I, during the last global sovereign debt bubble, there was the British way. The Brits were global reserve currency issuer for the prior 150 years, 200 years. The pound had been very stable for the past 100 years in gold terms, 150 years in gold terms. And so the Brits said, look, all this spending, we went off gold, and now we're back on gold, and we want to get the pound back to the pre-war parity on gold. Okay, what did they do? Unemployment in Britain from 1921 to 1941 never went below 7%. And 6% of the adult working age men died 1914 to 1918. So tragically, 6% of the workers were killed. And then you still never had unemployment go below 7. And it spent 30s like 12 to 14. So basically, to get back to sort of parity, to get out of it by deflation, restructuring, not spending, you had to go through a 20-year Great Depression. And, it's not often highlighted, but you were starting to have fascism, communism make serious inroads politically in Britain by the late 20s, early 30s. So practically, economically, politically, could never happen. You can't, even economically now with our debt to GDP where it is, it can't happen because with a debt-based system, you can't have deflation. So it's not even an option anymore. But the other way to deflate is what the Germans did in extremis, which is you had 400% debt to GDP in Germany after World War I. You hyperinflated away in a few months. Gone. Reset. Have a good day. Now, in between that, you had the French who devalued the franc 2 or 3 different times through the 20s. And Japan inflated, Russia hyperinflated. It's a very rare country that can, in history, that decides to shrink itself to maintain the real value of its debt when the debt is denominated in a currency.
No, that makes sense. You mentioned earlier right there that there might eventually be like the repricing event. Very long term, like what would you say might that be for gold and Bitcoin? Like where might we see them?
I've gone on like sort of 2 different metrics for gold. One is relative to the foreign held portion of the U.S. debt, official debt, excuse me, for sovereign debt. And, that number is like 8-9% now of at market value, U.S. official gold divided by foreign held portion of treasury debt, 8-9%. It was 20% in 1989, 2.25 times, 2.5 times, 2 times. It was 40% long-term average. It was 135% in 1980. So, 2 to 13 times the current price. So whatever, 6,000 to 40,000 in gold, assuming no further increase in debt, foreign held debt. That's a pretty good metric. I've looked at it as a ratio of oil too, because again, if we're moving multi-currency, we are. It's not even an if. We're moving to multi-currency. As that happens, there's no other debt that is big enough, that wants to be big enough, or that is big enough to serve as the reserve asset for net settlement purposes of oil and other commodities priced outside the dollar. It's only gold. And the oil market alone is 12 to 14 times the size of the gold market in annual fishing terms. So there too, we get to 8 to 10 times to be big enough to sell just oil on an annualized basis. You could say, okay, well, you only need net settlement. You say, okay, great. Maybe you haircut that. You're still talking 2 to 4x, in my opinion. So, and I think Bitcoin would be a multiple of that. Ultimately, it is a harder currency or a harder reserve asset with a higher stock to flow, if not already, then soon. And so, whatever multiple I apply to that, I ultimately would apply, I think, a bigger multiple to that.
In this frontier moment, Luke is discussing potential price targets for gold and Bitcoin. To provide historical context, we can look at the last 2 major bull markets for gold. In the 1970s, gold surged from around $50 to over $650 in less than a decade, a 13x increase. Also during the 2000s, gold climbed from approximately $300 in 2001 to nearly $1,900 by 2011, a nearly 7x increase. So currently gold is a little higher than 2x from its low in 2014 this past cycle, indicating that Luke may be right that we're about to enter an acceleration phase for both gold and Bitcoin. And now back to Luke.
Particularly when you start pulling in some of the asset gains from bonds, from real estate, for Bitcoin.
It makes sense. 2 more questions and we can start to close it out. What's something that you believe that most people in the Bitcoin community would disagree with?
That gold can outperform Bitcoin for a few years, still from here. And the reason I think that is possible. I'm not saying it's not my base case per se, but the reason I think it is definite, it's not a tail risk. It's more than even a fat tail risk. I think it's a distinct possibility, is that if we believe that certain global policymaking interests view Bitcoin as a threat to the status quo monetary system, and I think that's a fair assessment, then there's only a couple of things they can do to defend their franchise. One of which is to inflate gold a lot and basically move to that. And so that, to me, I think is an underappreciated. It's not even a risk, but it's partly why, there's people say, well, I only want to own Bitcoin. I only want to own gold, including a lot of people I respect greatly. For me, personally, it's a personal choice. Everyone needs to make their own choice. But for me, I think Bitcoin's going to win ultimately, but I don't know what ultimately is. And I think in the meantime, if you came to me and said, Luke, you are now one of these, apparatchiks, sitting in Basel, Switzerland and meeting every 6 weeks, talking about the global monetary system, and you see Bitcoin as a threat, what do you do to defend the system? Well, I need to reflate it anyway. I let gold go. And I reinvigorate gold. Will that stop Bitcoin ultimately? Might not. Will it buy my system time? You bet it will. Is it something I need anyway? You bet it is. We just talked about that. So that's something that's how I would answer that.
Last question. What would you say is the biggest risk to Bitcoin and gold?
I think the biggest risk to Bitcoin and gold, I think the biggest risk for Bitcoin specifically is that the on-off ramps, particularly in developed countries, are closed, criminalized, what have you. That doesn't change anything per se. It slows adoption and it puts freedom-loving people into a very uncomfortable position of having to choose Bitcoin or America. And I hope that choice never happens. Quite frankly, if American policymakers close the on and off ramps, it tells you whatever we think of America is already dead. The concept of America as it was is already dead. And so, but that's right. Everything you know and love and a lot of your family, friends, et cetera, are all here. So that's, to me, a risk that I hope I don't have to really think about more than I just did, but I'm aware of it. For gold, it's kind of something similar. I mean, we've already lived through a period of time where the creation of paper gold derivatives, this unallocated gold centered in London, just the unadulterated expansion, we lived through that already. That was probably mid 80s through, not that long ago. I think it's that part of is winding down for a pretty simple reason, which is commodities are now priced outside the dollar. And so, when commodities were only priced in dollars, when gold went up in yuan, that meant the yuan was weakening against the dollar. When you have multi-currency oil pricing, when oil's priced in yuan, when gold goes up in yuan, it means gold buys more oil in China than it does in America, than it does in London. And you start to see gold leave the West and go east. It's very subtle, but very important. And what that means is that basically the paper derivative unallocated gold game is over as soon as you have multi-currency energy pricing. So I think that's winding down. Look, that could come back, particularly, look, if we overthrow Putin and we put in some Western puppet who, stops facilitating non-dollar energy trade, and then we go to China and we sort of get Xi thrown out and we replace the government with some sort of Western favorable like. And then, by the way, I think I'm trying not to laugh as I say these things because I don't think either of those things are going to happen. But again, I want to be open that they could. Then those would be the risks to gold, right? Where okay, we're going to go back to this world where there are certain interests in the U.S. that do not want to see gold go up. And I think those interests are bad for America. I think they've been wrong on economic policy. I think they've been wrong on foreign policy, trade policy, but that doesn't matter. They could come back. So those types of things. I mean, obviously, confiscation is always a risk there as well. In theory, it's easier to confiscate because it's physically here. But again, if we get to the point where they're confiscating private property in America, because again, in 1933, gold was money. The government had a right to call the gold. It wasn't the right thing, in my opinion, to do, but they had a right to do it. It's private property now. So people say, well, gold could get confiscated. Yes, it could. And Like there's in America, I bet you there's maybe trillion 5 in privately held physical gold. There's like 30 trillion of retirement assets, right? So then you fall back to what Willie Sutton says, right? Why did you rob banks, Willie Sutton? Because that's where the money is. Okay. But if the U.S. situation gets to where it is and you're worried about gold confiscation, why would you go and try to confiscate physically a trillion 2 in gold, best case? And oh, by the way, tends to probably be a better, a populace that is, how should we say this? Better armed than the average American citizen. When you could literally get on your computer, type in a few keystrokes and take 20-30% of 30 trillion in retirement assets before you finished your first coffee in the morning. I know what I would do. So, it's a tail risk, but I have faith we're not going to go down those roads in America. And if we do, I would be a lot more worried about, the money I have sitting in 401k IRAs than I do in pensions than I do in gold or Bitcoin. Like I can make that stuff move. They've got their hand in my pocket already with all the others.
I agree. Definitely makes sense to hold physical gold and physical Bitcoin. Luke, thanks so much for taking the time to do this. Where can the audience go to learn more about what you're doing and where they can find you?
Sure. So check out our website, fftt-llc.com. More information on both our institutional research products and our mass market research products. And as you know, I've got a pretty active X feed at Luke Gromen, LukeGromen.
Awesome. Love it. Thanks, Luke.